interest rates play a crucial role in influencing the economy and financial markets. They affect borrowing costs, investment decisions, consumer spending, inflation, and the overall health of the economy. Let's explore the impact of interest rates on the economy and financial markets in detail. Borrowing costs. Interest rates directly impact the cost of borrowing for individuals, businesses, and the government. When interest rates are low, it becomes cheaper to borrow money, encouraging investment and spending. Lower borrowing costs stimulate economic growth by enabling businesses to expand operations, invest in new projects, and hire more employees. Similarly, individuals find it easier to obtain loans for purchasing homes, cars, or starting new businesses. Conversely, higher interest rates increase the cost of borrowing, which reduces the affordability of loans. This leads to decreased consumer spending and business investment, potentially slowing down economic growth. Investment decisions. Interest rates affect investment decisions by influencing the cost of capital. When interest rates are low, businesses find it more attractive to undertake capital-intensive projects, such as building new factories, expanding production capacity, or investing in research and development. Lower interest rates make borrowing cheaper and reduce the hurdle rate for investment, encouraging firms to undertake riskier ventures and stimulating economic activity. In contrast, higher interest rates increase the cost of capital and raise the hurdle rate for investments. This makes businesses more cautious and can lead to a decrease in investment, which may dampen economic growth. Consumer spending. Interest rates impact consumer spending patterns. Lower interest rates reduce the cost of borrowing for consumers, making it cheaper to finance purchases like homes, cars, and consumer goods. This stimulates consumer spending, which is a significant driver of economic growth. Lower interest rates also reduce the cost of credit card debt and other forms of consumer debt, freeing up disposable income for spending. Conversely, higher interest rates increase the cost of borrowing for consumers, reducing their purchasing power. This can lead to a decrease in consumer spending and, subsequently, slower economic growth. Inflation. Interest rates play a crucial role in managing inflation. Central banks often use interest rates as a tool to control inflationary pressures in the economy. When inflation is rising above the desired target, central banks may raise interest rates to cool down the economy and reduce spending. Higher interest rates make borrowing more expensive, which reduces consumer spending and business investment. This helps to curb inflationary pressures. On the other hand, when inflation is below the desired target or the economy is in a downturn, central banks may lower interest rates to stimulate economic activity. Lower interest rates encourage borrowing and spending, which can increase demand and potentially push inflation towards the desired target. Financial markets. Interest rates have a significant impact on financial markets. When interest rates are low, fixed income investments such as bonds and savings accounts become less attractive because they offer lower returns. Investors may choose to move their money out of these lower-yielding investments and into higher-yielding ones, such as stocks or real estate. This can lead to increased demand for stocks and other assets, driving up their prices. Conversely, when interest rates rise, fixed income investments become more appealing as they offer higher returns. Investors may shift their funds away from riskier assets like stocks and real estate and move towards safer investments, putting downward pressure on asset prices. In summary, interest rates have a significant impact on the economy and financial markets. They influence borrowing costs, investment decisions, consumer spending, inflation, and asset prices. The actions of central banks and market forces collectively shape interest rates, with the aim of maintaining a balance between economic growth, inflation, and financial stability.